friends, welcome to the BFM Crash Course day number 3, and our chapter of discussion is unit number 25 of BFM, and the chapter name is Treasury and Asset Liability Management. Every fact is been presented in this particular diagram format so that your concept become clear and you can confidently answer any question which is asked from this topic in the examination. So let's get started with our first topic that we have. Let's simplify a crucial concept in banking that is called asset liability management and liquidity risk. Why does it matter? Well, for banks, balancing their asset and liability is like walking a tight rope. A wrong step can lead to liquidity crisis, but don't worry, I will break it down for you in the easiest way possible. First thing we have, is called the nature of assets and liability. You can see on the left hand side, the natures of assets and liability. So what does it mean? Let's see. First thing is that you can think of asset like cash inflow. You can think of them like cash inflow. That means incoming cash, right? So incoming cash is asset. I told you earlier also. That means when loans are repaid, whenever loans are repaid, money comes into the bank. That is why loan is a kind of asset to the bank. And if we talk about the liability, right? If we talk about the liability, you can think of the liabilities as obligation, right? Obligation. You can think of them kind of obligation. Right, liability you can think of the kind of obligation that suppose when the deposit mature, right? Any kind of deposit suppose when mature, right? So deposit maturing, money will flow out. So that is called liability. And this ALM ensure that a bank never run out of cash due to mismatch between these inflow and outflow. So we can see from asset cash is inflowing, from liability cash is outgoing. ALM ensure that there is no mismatch. Bank never run out of cash because of the inflow, because of mismatch between inflow and outflow. So that explains this nature of the assets and liability. Second thing we have is the measuring liquidity. How do we measure the liquidity? Let's see. The key question, does the bank have always enough cash to cover its immediate liability? Does the bank always have enough cash to cover its immediate liability? The answer is the net liquidity. Net liquidity decide that. Means the cash resource versus short-term obligation. See, whenever I say net liquidity, on one side we have cash resource, right? And versus what? Versus short-term obligation, right? So if liability exceed the cash source, if short-term obligation exceed the cash source, the bank could face a liquidity crunch. Short-term obligation, or we call it liability, if it exceed the cash resources, the bank could face a liquidity crunch. That is how we measure the liquidity. Now we have something called liquidity gap analysis. As you can see on the left side, this is called liquidity gap analysis. Friends, bank categorize their cash flow into time bands. So here comes the concept of time bands. What the bank do? Bank categorize their liquidity in the liquidity gap analysis. The bank categorize their cash flow into time bands. As you can see next, so this is as per the RBI guideline. Right, this is as per the RBI guideline that in the next day or 2 to 7 days or 8 to 14 days or 15 to 30 days, right? And one thing is very important, that the meaning of positive gap and the negative gap. See, what is the meaning of positive gap? Positive gap means what? More cash coming in. It means advance is greater than deposit. And what is the meaning of negative gap? Negative gap means that more cash going out than coming in. This means deposit is greater than advance, right? So deposit is greater than advance, this means negative gap, right? So now friends, I think we have already discussed the source of fund like loan repayment. Loan repayment is a kind of source of fund, and we have already covered the usage of fund. So what is the usage of fund? Like deposits, obligations, right? So these are called usage of funds. Now the source of fund and uses of fund, you find the difference between them. Source minus uses will give you the liquidity gap, and gap can either be positive or gap can either be negative. Right, if gap is positive, it means advance is greater than deposit. Gap is negative, it means what? Deposit is greater than advance. So how do you find the gap? You subtract the source of gap from and you subtract the uses of the gap. You subtract both of them and you will get the liquidity gap. This is how we calculate the liquidity gap. Now the question is how to manage the liquidity risk, right? So let's see, at the top you will see the managing the liquidity risk. So RBI plays a key role here, right? Insofar as managing liquidity risk is concerned, RBI plays a key role here because RBI set threshold, liquidity threshold is set by RBI. You can see, right? So marketability is the key for liquid asset, right? So liquid assets should be marketable, and RBI is focused on short-term liquidity. RBI is always focused on short-term liquidity, right? And RBI has kept some threshold on maximum negative mismatch. Like you can see, in next day, maximum negative mismatch can be 5%. In 2 to 7 day, maximum negative mismatch can be 10%. In 8 to 14 day, maximum negative mismatch can be 15%. 15 to 28 day, maximum can be 20%, and so on. So the focus is on short-term liquidity, so that bank never run out of the cash unexpectedly, right? So this is how the RBI prescribe to manage the liquidity risk. So they put a threshold limit on the maximum negative mismatch, that for the next day maximum negative mismatch should not exceed 5%. That is the point, right? And based on these, numericals are also asked, which I have added in today's quizzes. If you solve the today's quiz, which I have added in the crash course folder, you will get to know how to solve question based on them. But for the time being, you remember these limits: next day 5%, 2 to 7 day 10%, 8 to 14 day 15%, and 15 to 28 day 20%. Now friends, let's look at the liquidity and the cash flow. Here you can see, let's talk about this liquidity and the cash flow. Basically, a bank with a positive cash flow is in a strong position. Obviously, if it is a positive cash flow, it means a strong position. And what are the key sources of liquidity? Some of the key sources of liquidity are, cash reserve, credit line, liquefiable security, and the nostro balance. Now, what about the contingency measures? What about the contingency measures? Here you can see. Let me show you. So in the top right side, you will see contingency measures. Basically, what if a bank suddenly need more cash? No worry, they have option, like now a standby credit. Yes, a standby credit option is available for them, right? They can take a standby credit from other banks, or they can take liquid investment. They can take help of liquid investment that can be quickly converted into cash, or they can borrow from via RBI by the means of LAF, liquidity adjustment facility, or TREPS, right? Repo, TREPS. Now friends, let's talk about the currency mismatch risk. What is the meaning of it? See, bank deal in multiple currency, and fluctuation can cause the currency mismatch. Obviously, suppose two currencies are there, USD and INR, and suppose both are fluctuating. So this fluctuation will obviously cause, currency mismatch. Who manages it? So it is managed by, the Treasury department. The Treasury department manages the currency mismatch. So inflow and outflow of different currencies is managed by the Treasury department. And what is the RBI guideline? RBI ensure that bank follow a strict liquidity management rule, right? Bank must organize their assets and liability into time buckets. I told you early that yes, bank have to organize the assets and liability in the terms of time bucket, right? And monitor maturity mismatch more closely. Why? To prevent market liquidity dry up and for illiquid security issue. So final takeaway from this entire discussion is that, ALM and liquidity risk management is like a financial balancing act, ensuring that bank always have enough cash to meet obligation while also making profit, right? So we have seen what are the limits placed by RBI in the managing liquidity risk. We have seen the nature of assets and liability, right? We have seen how to measure the risk. We have seen liquidity gap analysis, RBI guideline, right? Time band and maturity. We have seen how bank deals with the contingency measures, currency mismatch. What is the role of currency mismatch here, and how liquidity and cash flow are related, right? So this is the first slide. Now let's look at the second slide. Let's look at the interest rate risk in ALM. So friends, let's talk about it. Ever wondered how bank deal with the interest rate fluctuation? One wrong move and their profit could vanish. That is why they use ALM, asset liability management, right, to tackle the interest rate risk. Yes, ALM is used to tackle the interest rate risk. But what exactly is it? Let's break it down using this flow chart. In this diagram, everything will be clear. First of all, you have to identify the mismatch. On the top right section, you will see identifying the mismatch. The biggest challenge is the repricing mismatch. This is one of the biggest challenge, so-called repricing mismatch. So what bank do? Bank categorize assets and liability into time buckets. I told you early that bank categorize assets and liability in terms of time bucket, right, to track when they reprice. So basically, what bank want to track? Bank want to track when they will reprice, and for that, what they do? They categorize assets and liability into the time bucket. And what are the time bucket? We have already covered in the previous lecture. I think there are 10 time buckets which is prescribed by RBI. So for example, let me give you one example. A 7-year fixed rate loan at 7% versus a 6 month to 1 year loan. Right, again I'm repeating, 7-year fixed loan at 7% versus 6 month to 1 year loan create a mismatch. Obviously this will create a mismatch because this is a 7-year fixed percent a deposit, or you can say it, right, you can say it deposit. And versus on the other hand, what we have? On the other hand, we have, you can see versus loan. Suppose this 7-year fixed 7% deposit and on the other hand we have loan, you can see 6 months to 1 year. This will create a mismatch. Suppose interest rate rise, what will happen? One side earn less while other cost more. That is the point. I hope that makes sense to you. You have to identify the mismatch. Now let's look at the definition part. You can see the definition and impact. So interest rate risk is simply means that your earning is less than your payment. Whenever your earning is less than your payment, or we can say your expense, right? Or better word to use, your expense. Whenever your earning is less than expense, right? This will create interest rate risk. And when market rate change, bank may pay higher interest on deposit but earn lower interest on loan, right? That will what we call NII. You know what NII? Net interest income, which is interest earning minus interest expense. Suppose interest earning is less than interest expense, then what will happen? Obviously bank is exposed to the interest rate risk. So this mismatch leads to NII erosion of NII, affecting the bank profitability. Now one more thing is very important here, that is called repricing risk. You know about it. Basically when assets and liability reprice at different times, it causes earning instability, right? Assets and liability are being repriced at different timing. For example, suppose there is a floating deposit of 6 months versus fixed loan of 5 years, right? This is a kind of repricing. So if deposit rate increase but loan rate remain fixed, the bank profit take a hit, right? Again I am repeating, suppose floating deposit 6 months, fixed loan 5 years, right? So in this case, suppose if deposit rate increase but loan rate remain fixed, the bank profit take a hit, right? Now the question is how to measure this mismatch. So repricing risk, I hope it is clear, because the timing of the assets and liability maturity is varying, right? That is called this repricing risk. Now how to measure this mismatch? One thing is quite clear, that mismatch is always there, right, between our deposits and our loan, right, between our assets and between our liability. How to measure them? So bank track the mismatch using absolute mismatch, right? What is the meaning of absolute mismatch? Which means difference between RSA and RSL. RSA means rate sensitive asset and rate sensitive liability. The first technique. Second technique they have is the sensitivity ratio, which is the impact of rate change. And the third technique is RSA percent versus RSL percent, right? So there are 3 ways to measure this mismatch. I hope you are familiar with this term, net interest income, right? It is nothing but interest earning minus interest payment. Higher interest rate risk can destabilize NII, right? Bank aim to keep this NII stable, right, to ensure financial health. Example I am giving you to make this concept more clear. So suppose scenario number 1, we have a fixed loan versus floating deposit. Fixed loan versus floating deposit, right? Deposit for 6 months at the rate 5%, loan at 5 year at the rate 7%. So what is initial NII? Initial NII you can see is nothing but 5%, 7% minus 5%, which is equal to 2%. Okay. Now if suppose deposit renew at the rate 6%, so instead of 5% it becomes 6%, then NII will become 1%, right? And suppose deposit renewed at the 8%, then NII become minus 1%. So you can see deposit rate is so you can see that deposit rate is increasing, so NII is decreasing. But suppose instead of that deposit rate fall, then NII will rise. That is the scenario number 1. Let's look at scenario number 2. We have fixed deposit versus floating loan. In the case loan was fixed, but now suppose deposit is fixed. Suppose in this case deposit is for 5 years, which is fixed, and 3 month and it is funded by 3 month Hujan's bill discounting. Now in this case suppose rate is falling, right? What will happen? So low discounting yield and fixed deposit cost and NII decline. So we have seen both the scenario, right? In first scenario our loan was at fixed rate, in the second scenario our deposit is at fixed rate. You can see in both the cases, if interest rate is changing, consequently it has an impact on NII, right? So you have to decide. So you can't say that we can one case we can ignore the impact of NII. No, in both the case our assets and liability are exposed to this net interest rate erosion. Sometimes it is erosion, sometimes it is expansion also. Now friends, how to manage the interest rate risk? So bank takes some proactive step to minimize the risk. So what they do, they monitor the preset limit, right? They use something called derivative, and they use swap floating, right? Fixed or floating. That swapping is a method, right? So friends, interest rate risk is a game changer in banking. If not managed well, it can shrink profit and cause financial instability. But with proper ALM strategy, bank ensure they stay profitable no matter how interest rate might move. So friends, I hope this particular table help you understand each and every aspect. First of all, we understand what is mismatch. How do we identify the mismatch? how do we measure the mismatch, what is repricing risk, what is the impact of repricing risk. We have taken one example, what is NII. We have taken one example to understand that yes, either we have the case of fixed deposit, or we have the case of fixed loan. Both cases are exposed to the net interest income risk, and finally we deal with how to manage the risk. That's it, right? I hope that makes sense to you. Now friends, let's look at the use of derivative in asset liability management. Very, very important. Ever wondered how bank handle risk when interest rate fluctuate or currency value change? Right. So the answer lies in the derivative. Derivative are like, financial tool which help bank hedge risk, manage liquidity, stabilize earning. Friends, if you are looking for such kind of videos which clear your concept in hardly 30 minutes, right, you don't have to go through the lengthy videos which take 5 to 6 hours to clear a concept. Yes, we have also that, but at this time what is required, to put more time to practice, right? It's not that time that you put more time to theory reading. So what is our main motive through the crash course is that you devote at least 80% to 70% of your time to practice through MCQ solving, and just 20 to 30% to the theory reading through videos or through PDF. This PDF will help you revise the concept quickly, fastly at the last time. As you can see, they are the short and crisp note possible. You can take help of our crash course. For more detail, feel free to WhatsApp me through this particular number. Right, please note down the number 8292857381 for any detail related to the crash course or any study material related to CAIIB. Friends, let's continue our discussion. So friends, let's talk about first of all currency mismatch. Right, I think we are familiar with it. Foreign currency loan receivable faces risk due to exchange rate fluctuation. What is the solution? The solution is that bank use call and put option here. Right, so they buy call. So by buying the call, what they do, they hedge foreign currency loan repayment. Right, if suppose currency appreciate, no extra cost, and if they buy put, then they protect foreign currency receivable value. Right, so this is, you can see, currency mismatch can be taken care of by using this call and put option. Now the question is managing the risk. You see, bank use derivative to control liquidity and interest rate risk. For both of them, either liquidity risk or interest rate risk, bank can use derivative. A structured risk, you can see, a structured risk mitigating product replicate market movement for better risk control. Right, now there is something called treasury arbitrage. Do you know about this treasury arbitrage? You see here, treasury arbitrage, what it is. See, bank borrow in one currency and lend in another to earn profit. So they borrow in one currency and lend in another to earn profit. As you can see, they borrow dollar for 6 months at the rate 3%, right, and they lend that money in Indian rupees for 6 months at the rate 6.5%. So what is the gross spread here? If you see 6.5 minus 3, which is equal to 3.5%. So this is the gross spread for the bank, isn't it? So after hedging foreign exchange risk, which is the premium, which is 1.5%, the net profit is just 2%, because this is the spread, this is the ultimate profit. But there are some premium they have to pay, and what premium they have to pay? Premium almost amount to 1.5%. So we have to deduct this premium from the spread, and finally the net profit is just 2%. So you should know how to calculate the arbitrage, how to calculate the spread, how to calculate the net profit, because some numerical based question may be asked. Now friends, let's look at how do we structure the banking products. Right, how do we structure the banking product? So let's see here, let's see the top right corner. Right, basically there is something called floating deposit or floating loan. If product is like floating deposit or floating loan, then it is linked to the benchmark for better control. Better is to link to the benchmark. This is how you control them. And suppose your product is government security. If it is government security, then inflation linked for stability, then it should be linked to the inflation. Or if it is a corporate debt, suppose it is corporate debt, like suppose it is a call put, so call put option, so then in that case call and put option will boost liquidity. So remember, depending on the types of product, you can use different technique, right, to hedge this asset level or interest rate risk and liquidity risk. Again I am repeating, if it is floating deposit or floating loan, you link it to benchmark link. If it is government security, it should be inflation linked. If it is corporate debt, it should be call and put option linked. For example, you can see here a 7-year bond with put option at the rate 3 year is equal to 3-year investment. It acts like a 3-year investment, right? So this is how you should structure banking product. Like we already know that whenever you take any kind of loan, it is always linked to the benchmark link, obviously. Now friends, if we talk about the hedging strategy, suppose bank hedge market risk using derivative like index future. Yes, so sensitive stock market risk, obviously. And how do they use? So they sell index future to hedge such kind of market risk. If they sell index future, it protects a stock price from falling. And low capital requirement, making derivative an efficient hedge, right? Now friends, if you look at the IRS, you know what IRS, that is called interest rate swap. You see the case of IRS here. See, the problem is that basically this IRS or interest rate swap, it protect you from maturity mismatch. It protect the product from maturity mismatch. How? Let's see. Friends, suppose loan tenure is 3 years, right? And deposit tenure is just 3 months. This is the problem. The problem is that loan tenure is 3 years, but deposit tenure is just 3 months. This is the main problem. So we have a short-term deposit, as you can see, just for 3 months. So it is a cheaper but risky, right? So liquidity is always there, right? And interest rate risk is also there, because it has to be repriced 12 times. Now you can see 3 year means how many? 3 year means 36 months, and just your deposit is 3 months, so it has to be repriced 12 times. The deposit has to be repriced 12 times. So obviously it is exposed to the interest rate risk, and obviously liquidity is always there, right? So what is the solution? The solution is that you use interest rate swap. This is the solution. So I have told you the problem. I have just shown you the problem, that yes, we have to reprice the deposit 12 times, and obviously it is exposed to the interest rate risk. What is the solution? You use interest rate swap. What you do, you convert this the floating rate 3 month to fixed rate 3 year. This is how you should use swap. What you did, you convert the 3 month deposit which is floating to 3 year fixed, right? So what is the effect? What is the effect? The effect is that you receive your loan spread remain stable. First effect. Second thing is that you receive floating treasury bill, and you pay fixed, and you lock the deposit cost, right? So 3 month deposit effectively become a 3 year deposit. So this is the advantage of using the interest rate swap. Now obviously we have just seen the advantages of these kind of techniques, like call and put option, like the interest rate swap, right? But there are some limitations also. Effective ALM require rational pricing. Yes, this is very, very important thing. Rational pricing is required, right? But swap fall if rate are not benchmark linked. Remember it, swap will fall if your rate is not benchmark linked, then swap will fall, right? So, and there are some embedded option. What is the meaning of embedded option? So embedded option like prepayment. Suppose I took the loan and I prepay the amount. Suppose I have a deposit and I ask the immediate withdrawal, premature withdrawal. These are called embedded option. This embedded option can bypass ALM and hedge limit, right? So what is the solution? The solution is that a strong derivative market, skilled dealers, and efficient risk management. This is the solution. So first limitation of derivative is that it requires rational pricing. And the swap fail if rate is not linked to your benchmark, then swap will fail. Yes, interest rate swap will not happen, will not benefit you, right? So the solution I have told you. So derivative are a powerful tool for bank to hedge risk, to manage liquidity, and to ensure stability. But without proper ALM strategy, they can backfire. That is why bank carefully structure product. I told you now, a structuring product is very much required. I told you at the top. You see why we structure banking product. We link this floating deposit and loan to the benchmark. This is very important, because derivative will work only when this is linked to the benchmark link. This is very important. Government security should be inflation linked. Corporate debt can either be call or put option, right? So I told you the limitation also, I told you the advantages also. That is all we have seen in this particular slide. You can see the efficiency, right? In the 2 pages of Macmillan book is just covered in one single slide, every aspect, right? So friends, it takes lots of effort to prepare such kind of content. It require your recognition. It require your, please hit the like button, right? Now friends, let's look at the credit derivative. Very, very important thing. In just one single slide, you will cover every aspect of credit derivative. Have you ever wondered how bank and financial institution manage credit risk without actually selling the loan? Yes, they manage the credit risk without actually selling the loan. The credit derivative make it possible. These financial instruments allow risks to be transferred. So see what is happening here, that just wait a minute. So what is happening, that risk is transferred from one person to another, right? Ensuring better capital efficiency. But are they risk free? Let's see. So first of all, let's look at the definition, right? What is credit derivative? See, credit derivative are like financial contract, right? That help institution transfer. It help institution transfer credit risk, right, from one entity to another without selling the underlying asset. We don't need to sell the underlying asset, but what we are doing, we are transferring credit risk from one entity to the other without selling the underlying risk, right? That is the definition of credit derivative. Again I am repeating, you are transferring risk from one entity to the another without selling the entity, underlying asset. You are not selling the asset, but rather you are transferring risk from one entity to the other. Now, what are the benefits of credit risk, credit derivative? The first is it diversify your credit risk, that it reduce the exposure to the single borrower. Second is efficient capital utilization, which means bank can lend more while keeping risk control. The third is transferable instrument. So these contracts can be traded in the market. The fourth is governed by ISDA master agreement. You know ISDA, International Service Derivative Association. So basically it is ensured that standardization and legal framework. So this ISDA master agreement ensure standardization. Two things it ensure: standardization, and the second thing is legal framework. These things are ensured by this ISDA. So these are the specific benefits of this credit derivative. Now if you look at the key instruments which are used here, what are some key instruments? The first is CDS, that is called credit default swap. So what happened in this credit default swap? It is a kind of contract where protection seller compensate a protection buyer if a borrower default. If a borrower default, then seller will compensate the buyer. And the second instrument we have is credit linked certificate, which means a security where returns are linked to the credit risk. So friends, how do credit derivative work? If you look at the mechanism here you can see the mechanism. What happened in this case? Protection seller, like insurer, we also call it the insurer. It's just like insurance. So protection seller like insurer guarantee payment in case the borrower default. Suppose borrower default, those who has taken the loan default, right? So suppose borrower default, then protection seller guarantee principal payment, and protection buyer, which is the bank, because bank is buying the protection buyer pays a premium to transfer the risk. Yes, they pay a premium, and if the default really occur, the seller compensate the buyer for the loss. You can think of it like car insurance. You pay a premium, and if accident happen, the insurer cover the damage. That's it. Now, who are the participant in this credit derivative? Let's look at it. The participant. The first participant is the protection buyer, right? That means the bank, the investor, right? They want to hedge against default risk. The second is the protection seller, means insurer, means hedge fund. They take the risk in exchange for premium. Yes, they get the premium and they take the risk. And the third is the reference asset, which means the financial instrument on which the derivative is based, like bond, like loan, on which this particular derivative is based, bond or loan. Now friends, if you look at the dark side, risk exposed during 2008-2009 crisis, credit derivative played a major role in the financial crisis. Here is why. The first one was the negligence in credit assessment. Many institutions blindly relied on derivative without checking borrower quality, right? This was what happened in 2009 crisis. You might know about Lehman Bank crisis, right? In USA, it impacted the entire global world. Then the second reason was the high leverage in the credit derivative. Excessive trading magnified the risk. Crisis escalation. The domino effect led to the collapse of major institutions like Lehman Brothers. The lesson learned is that credit derivatives are powerful tool, but when misused, they can shake the entire global economy. So final takeaway is that credit derivative offer huge benefit in managing the risk, but they must be used with caution. Bank and institution need better risk control and transparency to prevent another financial meltdown. So every aspect of credit derivative has been taken care of in this particular slide, right? And please hit the like button so that this video reaches other CIB aspirant also. Now friends, let's look at this particular point. Credit derivatives are powerful tool for managing risk, but without proper regulation, they can become a ticking time bomb, right? It can become a time bomb, just like what happened in the 2008-2009. So how does RBI handle this instrument? What is the RBI approach? Let's dive into RBI structured approach to credit derivative. First thing comes is the regulatory framework. In the left hand side, you will see, just wait a minute. In the left side, you will see a regulatory framework. You can see. So RBI has set a strict guideline to ensure that credit derivative don't lead to excessive speculation or financial instability, right? So regulatory framework has been put by the RBI. So what are some key regulations? Like market maker eligibility, which means only approved financial institution can trade. Second is the RBI guideline. It defines what is allowed and what is not. Then we have capital adequacy norms. That means it ensures that financial institutions have enough capital to absorb the loss. Because without these rules, reckless trading could lead to another financial crisis. And what is the role of bank here? You can see. Friends, bank and financial institutions plays a key role in credit derivative, but not just any bank can participate. See who can participate. Bank and primary dealer, they can participate. A strong NBFC, they can participate. NBFC, non-banking financial institution, RBI approved institution, they can participate. And insurer and mutual fund, right? Only if permitted by regulator. If regulator permit them, then they can participate. right? So these are the market participants in the credit derivative. You must note it down, right? So mutual fund, insurer, they can also participate, but regulator permission is required, right? The idea is that only well-regulated player can participate, ensuring market stability. Now friends, if you look at the eligible entity, so who can use credit derivative? Market maker, they provide liquidity and pricing. There are users who hedge their risk, and the bank and trading book. Financial institution that engage in trading and hedging activity. And what is the RBI cautious approach? That unlike some global market, RBI does not allow unchecked trading of credit derivative. Why? Because there is something called controlled risk exposure. It prevents excessive risk taking, right? And it avoids systemic crisis. So there is something called single name CDS. Single name CDS means risk transfer with a focus. One of the key credit derivative product is India is the single name CDS. That is called single name credit default swap. What it is used for? It is used for corporate bond, means hedging against the default. It is used for the risk transfer, which means allow investor to shift credit risk efficiently. So RBI has carefully structured the credit derivative market to ensure stability, to ensure risk management, to ensure limited exposure. Right. So friends, that is all you need to learn from this particular chapter, nothing more. Right. Please go through this once more, and then I request you to please solve the MCQs and case study and quizzes which I have added in today's folder. It will hardly take 1 to 2 hours of your time to cover it. Obviously 1 hour is more than sufficient, because there is hardly any numerical in this particular chapter. There is understanding what is repricing risk, what are the use of derivative, how derivative are uses, what is arbitrage, everything aspect like that.